Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Dearborn. He's the managing director on Nasdaq's Market Intelligence Desk, and we are going to take a look at the theme this week of moving from growth to value. Chris, it's great to have you with me. As always, my favorite hit every week, because I know we're in the home stretch to go home for the weekend, but that really seems to be the key this week, that conversation around shifting out of some of the momentum names and looking at value.
You've really had a nice shift. You've had good volume this week. There's really been a risk-on trade to a lot of beaten-up sectors and a lot of beaten-up market caps, right? You're seeing small-cap and mid-cap rallying here. We talked about that earlier in the week. You're seeing a nice move in the different cyclicals. That's really nice as well. And with that, you're seeing a lot of winners that have been really depressed for the last 3 months. Energy is a great example.
All right, let's take a look at our first chart here. This is a Russell 2000, 3-year on a weekly chart, and this is where we're talking about value.
I love this chart. So we've been talking about the Russell and the rebalancing that's been taking place, the recalibration of investments. So you're looking at a 3-year weekly chart on it, and we drew a line down from the peaks back in mid-18 to where we are right now, and you're looking at a breakout scenario. You know, can this happen? Yes, and it's got some legs to it. What we're looking at here is the possible move through 1585, which is only 4 handles away from where we are right now. And with that, if it continues to move higher, it's going to break out of this midterm cycle that we've been seeing here and potentially retest the old highs near the 1700 level. Again, you need to follow through for the mid and small cap names to continue to move here. But if you're seeing this valuation cyclical move that we are seeing right now, if that continues, that's going to give it a lot of legs here. And you got a lot of underlying factors that are very strong here. You get good unemployment, low unemployment, good. The consumer's holding up here now, especially with the retail sales numbers out today. Michigan manufacturing number was very positive. You know, so you've got a lot of items here that are giving this the oomph. What's going to be the rocket fuel that gets us here? We still got the Fed coming up next week. We can see what happens there. That could be a
bring that up with
but
everything.
And the China-U.S. trade talks, we're seeing a lot of give and take there. That's a normal sign of negotiations, not crazy tweets going back and forth, but a little bit of give and take. And China's like, all right, we're going to start letting the U.S., we're going to buy ag products from the U.S. again. And when Trump delays tariffs for another 2 weeks, that give and take is kind of what you need. So then you can start forecasting forward and get your modeling done as opposed to investing in an unknown macro environment. Things are looking okay. All
right, well, things looking okay, that lends to the question, why do we necessarily need rate cuts or to go to zero? We'll learn more about that next week, which brings us to our next chart. This is a U.S. Treasury, the 10-year yield curve that you guys took a look at
So
today.
Brian put this in the note today, and it's kind of interesting. So yields are definitely responding very well here, which means people are selling out of the bonds. Remember, a couple of weeks ago, the bond yield on the 10-year hit 1.43. It was really, you know, dogs and cats. You know what's going on. People are buying treasuries because they're nervous. They're buying gold because they're nervous. Get the stock sold off, but have bought back up here. What you're looking at is comparison from the yield curve for this week to last week. And what you're looking at here is a bear steepening in the curve. So it's not as predominant as what we saw back in 2016 following the presidential election. The curve looked very similar, and we're off to the races from there. So what you're looking at is the front end of the curve, the 1 month and shorter term treasuries are still being bought. They still got a negative yield on that. You're trading very lowly. However, you're looking at the 2, 3, 5, especially the 10-year, people are selling them out, which means the yield is starting to pick up. If this is the same type of curve that took place back in 2016, and we're seeing that same pattern take place here. What that means is that people are starting to sell out of the treasuries, people who were buying that fear trade, and it's a reflationary trade here, which means it's very good for the markets and good for the economy. If those stocks start to pick up, people will do that risk on, which is what we're seeing, very early cycle here. This could have significant legs, and this is an indicator to follow. The 10-year is absolutely something you have to keep your eye on.
All right, so outside of the Fed next week, we also have a number of other central banks with their meetings coming on as well. What are you going to be taking a look at?
You know, absolutely, there's one thing that everyone's keeping an eye on, and it's the 18th, right? It's a 100% chance that the Fed's going to cut them by a quarter basis point. That's baked in or here already. The question is, what are they going to say? Remember, after every rate cut, July is a good example, look at the beginning of the year, his commentary out of the initial 30 minutes really sank the market. So is he going to be guarded? Is he going to be, what's going to be said there, what we're looking for? He has the capability of sinking or buoying up this market right now on how he answers those questions. And does he take a conservative approach? Does he say the right rhetoric like he did at Jackson Hole? Right? Powell spoke the right words there. Does he do the same thing? We hope so. But again, it depends on what they see. If, you know, they're independent of the White House, even though a lot of people don't think so, they are. And what he says here will make a difference in the market. Again, we don't get the actual transcript for a couple weeks later and find out what the actual debate was going on in there. But if they cut it a quarter point, if they mention anything on QE in the follow-up, this market's going to take off.
Right. Well, it also depends, too, what the tweet responses will be. Because we do get some normalization in the market that you get a crazy tweet on the overnight or before the open.
Right.
And that's really what's driving the action,
Right.
too.
The macro is driving the price action here. It hasn't. It's always been an influencer going back many, many years, but not so much as it has since beginning of this year, specifically right in February.
Well, you're also in an earnings vacuum, too, which kind of happens in that 4 or 5 earnings week flow. All right, Chris, as always, thank you for joining me.
Yes.
And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.